Welcome, family. It's another episode of the Deep Q Cast. You have your moderator-in-chief, Robert Ridzak, here. We have a pretty special episode. We have our first guest joining us, which we are really excited about. So we're going to be getting into that in a minute. As a quick recap for what the Deep Q Cast is about, it is about macro trading and digital assets. Deep Q Digital is a market maker within the digital asset space. With us, of course, we have our co-founder of Deep Q Digital, Carlos Zendejas, who's looking quite fresh with his vest on, along with our first guest, Yang Tang, who is a co-founder of Arch Indices, which is a IP indexing firm. Carlos and Yang know each other, I believe, through the industry, and he is quite astute within the market. So we were really excited to have you on, Yang. Thank you so much for joining us.
Thank you for having me on. It's a pleasure to be here.
Did Carlos ask that you wear a vest as well? Because I was really excited that all of us are wearing vests today.
Don't lie. You know we coordinated this. We all texted and said, "Hey, bud, let's live our best life today." Everyone rocked the Patagucci's for the podcast.
Yeah, I jumped on wearing a sweater and I realized I was grossly underdressed, so I had to throw
seriously.
it on myself. Yeah,
this is
you're
no kind of man unless you're rocking the Patagonia vest.
Well, yeah,
I know. I gotta get an update on mine. I think I ditched my Deutsche Bank one after I left the firm.
Although I do have a question for you, Yang. Did you? Yeah. You have a branded Patagonia vest.
Yes, I do.
And how did you? That's like a black market gold at this point. It's so difficult to come by. How the fuck did you pull that off?
Well, you have to be resourceful as a startup founder, and you kind of have to deliver results. So I think the first result is you have to deliver a branded Patagonia vest for anyone to take you seriously, which we did.
That is a requirement.
Yeah, that's a requirement.
Absolutely.
Otherwise, if you can't deliver that, what else, can't you deliver, right?
Fair enough. Well, either way, maybe I'll have to get in touch with you afterwards as to the best place to get a branded Patagonia vest, because I unfortunately am rocking just like a normal ass, straight off the rack REI version. I gotta get a Deep Q Digital vest for sure.
You just do like a patch. It's like an iron patch,
No, it's not. It's not. I'll get like a Scotch tape just to say like Deep Q on it.
Yeah, I love it. Yang, what do you? I'm glad Carlos filled you in on the fact that this is a happy hour and alcoholic beverages are not required but highly encouraged. I saw you take a swig of something. What do you have on today?
I got a very boring but delicious Carlsberg Pilsner. I started buying tall boys just because, to reduce the time to go to the fridge.
Oh,
that's awesome.
I love it. I remember going, I think I was out in like Belgium or somewhere, and they had like this like pops almost, and it's kind of like these like plastic caps that you have to like swivel off. It's very fancy. Carlsberg is one of my favorites. Takes me back.
What Yang forgot to tell you is that after this, he's about to go start a riot at a soccer stadium.
It's something they put in the drink.
Yeah, you got.
I don't even like soccer, and I go over there and I start cheering. It's crazy. It's weird.
It's more the experience in the sport, right?
Yeah, you gotta love it.
Yeah, Carlos, you just got your usual, huh?
No, I mean, listen, man. You got to stick with the classics. Bud Light always works. On sale at Costco. What more can I say?
Yeah, I mean, that makes like a frugal, good value, right? It's a good value for
yeah. Plus, it's America. It's America. You can't go wrong with that.
America in a can. Boys, what's been going on this week? Maybe what we could do for this show is run down some high-level macro themes and some recent news, and then we can dig into some a little more technical side. Obviously, leaning also on Yang's experience within on the technical side of markets. Can talk a little bit more about how commodities and crypto trading kind of relate. Maybe kick off
before we jump into that. I kind of want actually, before we jump into macro, I want to get I want to give Yang an opportunity to talk about why the fuck we should be listening to him talk about macro. Because little spoiler alert, Yang is probably one of the preeminent minds on macro that I personally know, and he's got the bona fides to back it up. So before we get into that, Yang, do you want to tell us a little bit about kind of what your background is and what you do, and you know, maybe get a little bit of a flex in terms of why we think you're such a good person to talk about macro.
Sure. You know, thank you for the introduction there. So a little known fact, Carlos and I go way back to, you know, our days in business school. So since business school, I've spent over a decade in macro sales and solutions. So I advise the world's largest banks, insurers, asset managers, and hedge funds on macroeconomic trends, as well as derivative and financing products behind that. So I've worked across the spectrum, mostly focused on rates, but cross-asset as well. And last summer, I started a firm, Arch Indices, to build macro asset allocation products, as well as investor goal-oriented products to bring institutional level knowledge of macroeconomics and asset allocation to the masses. So we have a very exciting product lineup, which, you know, I will be able to discuss with you guys throughout the show. So with that, you know, macro is a passion, right? Macro is a thought process. And, you know, from my experience working in commodity sales, macro sales, and advising, you know, some of the world's largest investors, we've seen a lot. And because of that, you know, we're able to apply that knowledge today and to think about the framework of how people should think about the markets, their portfolio, as well as asset classes.
Yeah, and fun fact, you started before business school. If any of you have seen the show Industry on HBO, Yang actually started out his career on the desk that inspired that show.
Correct. I was in a group called, at the time it was called Global Macro Solutions. They changed the name in the show to Cross Product Sales, but, you know, essentially that's what it was.
So the big question was, you know, is that show an accurate representation, or is it just a little bit maybe too much sex and cocaine?
You know, on the trading floor, I think it was quite accurate. And I think we both know who the main character is in the show. He is, I think he may be oblivious to who it is, but I think the world knows. You know, that side was, I think, pretty accurate. The extracurricular activities, you know, I think that's where the drama is, and that's where the Hollywood effect is.
Oh, for sure.
I can
tell you straight up though that like watching that show, at least the scenes that were filmed on the trading floor gave me a little bit of PTSD from when I was a grad. So it makes me happy.
You know, it did too. Like, do you remember the when Harper reversed the FX? She went like the wrong.
Yeah.
I'm sure that's happened to more than one person on this podcast.
Oh my God. So one quick war story. Just, I remember a time where we accidentally forgot to hedge. Like one of the algos missed a hedge, and we went to bed. And we were like, yeah, cool. We left for the day, and then we showed up the next morning, and our blotter showed us that we had a $75 million Aussie dollar spot delta. And like, this was our third week on the desk. Me in New York and the guy in London that was my counterpart were on the phone just being like, oh shit. So we panicked. We called up the spot broker. We were like, we need to get out of this risk. Get us fucking out of the risk. So we closed it out. Ended up actually by luck. I mean, this is maybe the one thing that saved our job is that we accidentally made $225K. And we rolled into our boss's office and we were like, dude, we didn't read the risk blotter correctly. We forgot to hedge out of position for a client. We rolled out of the office with naked like $75 million Aussie dollar risk. But the good news is we made money. And he's like, I do not give a fuck if you made money. That could just as easily have gone the other way times 10. And sufficient to say we got our asses chewed out, and well deserved. Yes. but I think that's a rite of passage for pretty much everyone. Like you have that like oh shit moment where like everything just drops to the bottom of your stomach. You're like, I'm gonna be sleeping on my parents' couch next week, huh?
Yeah. I had one as not me, but another associate bought Australian bonds instead of Austrian bonds for a client.
Oh God!
I mean, it happens, right?
Yeah. Well, there you go. So It's, like I said, a little PTSD. Those days, sadly, are not behind me. Actively trading a book, but I kind of like it. It's nice to be back. It's nice to be back, like actively managing risk and like actively looking at the markets. Because I think when you become senior enough at a bank, you spend most of your time in like risk meetings and talking to clients, and you kind of lose sight of like actually what it feels like to have your finger on like the pulse of managing risk. So it's been a nice little pullback for me.
Feel alive, adrenaline junkies.
I was chatting with Matt earlier today, and I'm like, I'm fucking just putting in some bids right now just to feel alive.
It's like great.
He's like, Carlos, you need to slow the fuck down.
Yeah.
All right. Anyway, so we actually got a really fun week in the market. Now, maybe not as fun as last week, but a lot of macro-driven stuff. And I'd say like the week started off with Jay Powell giving an interview to God knows who, some fucking dude from KKR. And amongst asking asinine questions like, hey, what's your preferred style of meeting with your coworkers? Do you like to talk to them on the phone, or is it best if they come by your office? It was an event, sadly, that really moved markets. I don't know. You have any thoughts on Jay Powell's latest rhetoric?
Yeah, I think it's very interesting, right? I think the history of the Fed the last couple of years has been the models are broken. So I think a lot of the things that we've seen is the fact that the Fed has no confidence where the economy is going to land, right? I mean, so I think it's very interesting that Jay Powell came out swinging very hard on the disinflation of the last week. So he reiterated that again, and I think that was what caught people by surprise, especially when you had such a large payroll print last Friday. I think beyond that, right, I think perhaps the Fed is getting ahead of themselves, or perhaps the market is getting ahead of themselves, and we've entered a phase of data dependency.
So if you were to say it, for our non macro experts out there, when you use the term data dependency, what do you mean by that?
Sure. So I think if we think about how a decision is made at the high level, right? The Fed has two goals. The first is to preserve employment, and the second is to preserve price stability. So if you go back to, I think, probably the early 80s, price stability hasn't really been an issue because the Fed has always been quick to raise rates. It's become an issue recently, right? So because of that, the dual mandate picture has come into play. So how the Fed thinks about the world is they have data inputs, they have a various amount of econometric models, and then they have an output. So, every time the Fed has a meeting, well, not every time, but every other time, they release, the famous dot plots and the summary of economic projections. That is the Fed's way of saying, based on what we see in the world, we expect the economy to be here. So if the economy does not end up where the Fed expects it to end up, that is a problem. And COVID really highlighted that problem because, if you shut the economy down and you give everybody trillions of free dollars, that affects price stability as well as economic performance. So at the moment, as you see the recovery open up, right, and you see, the pandemic fade away and people spend again, the Fed's models of one, where employment should be, and two, where inflation should be, have been utterly, utterly wrong, right? If you go back 1 year ago, the Fed thought inflation was well under control, it was transitory, everybody's going to go back to work, and inflation is magically going to go to 2%. That clearly didn't happen. That panicked the Fed, right? That led to actually probably the first emergency rate hike at the Fed since, I would think, the early 90s. And it's caused chaos. So in this grand picture, right, now you have data coming out, and the data is telling you one thing, and the Fed is going, we have no real way of having confidence in the outlook. Because of that, we have to adjust our outlook based on what the data comes in. So you've reached this strange place where every single data point and every single Fed speech can move equity markets 1%. They can move bond markets, 10 basis points on the 2-year yield, right? I think, if you go back and you look at data and you think about, all of our collective experiences, when was the last time a surprise job number has been able to move the markets for multiple days the way it has?
Mm-hmm.
Yeah, no, it's kind of insane. We actually talked about this a little bit on our last episode. So we had a conversation about what we called sort of high stakes modeling. And the premise behind this really is that, like, at the end of the day, you have, a dude with an Excel spreadsheet basically at the BLS whose model, which quite frankly, to be honest, like I'm not a big fan of macroeconomic models in the first place, because it's usually pretty sparse data. It's usually pretty archaic sampling methodologies as well. And at the end of the day, also, the Fed employs a tactic of moving the goalposts if it fucking feels like it, and changing the methodology behind everyone's back. And yet these models basically output something, and the market digests it as if it weren't a model. It digests it as if it were some like ground truth, like there were 1 billion people on the ground actually counting the number of jobs available. And it's somewhat of like this disconnect, because we put so much faith in these models and we don't really have a full appreciation of how archaic and slow and lagging these models are behind the actual economy. And so to me, one of the things that's really funny is that you have guys like Jay Powell, who I've always said, I've never seen a guy have more confidence in a wrong model than Jay Powell. And the degree to which he walks out, and like, you have to hand one thing to him. He is pretty good about giving guidance and doing that actual thing, even if he's dead fucking wrong. And so you'll have these models and they're like, yeah, well, we think, a period of disinflation is happening. Well, what about the job print? Fuck the job print. Or what about this? Well, that's not the way we look at that data. And you're like, all right, well, and now you have such massive uncertainty. I feel like what it's done is it's forced everybody in all asset classes, from equities, crypto, venture capital, real estate, everything, to now become a macroeconomic pundit.
Yeah, that's 100% correct, right? Like, and if you think about, just the jobs number, right? There's actually 2 job surveys, right? There's the household survey, and then there's the establishment survey. They pick up 2 very different sample sets of people. There is, I think, a very unknown fact about the last job print, which was they make statistical adjustments in number of jobs based on how many people they think have, been entered into the population or exited the population. It's called the birth death model. On top of that, right, there's pretty much, wild swings in the adjustments and corrections every month. So whatever prints this month is probably very different 2 months from now.
Yeah. So I guess that being said, we went from last week a random number generator of jobs, and now everyone's kind of waiting with bated breath now on the CPI for next week. What's your view on sort of like the market's expectation for CPI, and how we should be kind of looking at the macroeconomic environment given the potentialities of the CPI print?
Yeah, so I think the January CPI print tends to be extremely volatile because many prices reset in the month of January, right? As an example, a lot of services like, your utility bill may reset, right? Because the utility commission decides that the utility can pass on X amount more cost for the next year. So that resets January. Historically, January has been very volatile to predict because of that. I think overall the view is that January is going to come in a little bit hotter, but you can treat that as a blip, due to that effect. I think, people look at what they think are forward indicators, which are rent prices, nationwide. They look at certain goods prices, they try to somehow measure some level of services prices. And then, of course, we're all humans, right? We live in anecdotal worlds. So, you go to your restaurant and the restaurant owner goes, oh, yeah, I'm having, much better time hiring people. And you kind of think, oh, my God, like the economy is getting better. So I think there's a lot of, human biases that go into this. But I think overall, the January one is going to be volatile and is likely to be on the higher side because of price resets that you saw from the last year, which was, again, a very high CPI environment.
So you're talking almost as if like macro investors are rational, and what I've seen is they collectively tend to lose their shit on these sorts of things. I'm like, I actually think that because the market is priced in so much good news, like so much rosiness, right? I think if you look at like all of these asset classes, they're effectively priced in that we're going to pull off like a Sully Sullenberg landing a Boeing 747 in the middle of the fucking Hudson, like a miracle, and have a soft landing. I think that like if the markets were truly rational, they'd be like, oh, it's a blip for X and X reason. But to be honest, I kind of look at this and I say, if we have like given jobs, given the fact that we've already had this sort of like this number up, my view is if we miss by more than like 0.2% or something like that on CPI, I'm personally preparing for the market to just shit itself.
Yeah, I agree with you there. I think, January was crazy, right? Like, I don't know if that was just people coming out of tax loss harvesting, if people just had a really good holiday and they feel refreshed, like they're ready to go slay the dragon. If people actually...
Yeah, that's what I was thinking.
Yeah, I mean, there's a number of reasons, right? I'm sure you guys all remember the analogy, like the market's kind of like a beauty contest, right? Except you're not judging who the most beautiful person is. You're trying to judge who other people think the most beautiful person is. So that's kind of the craziness of the market, right? So you have that. And then you have, I think, what is an interesting market structure. Because of all the Robinhood apps, there's people that do nothing but day trade, 0-day, 1-day options all day long now, right? Which is a glorified form of gambling. And that affects, I think, a lot of, flows into the market. But yeah, I mean, if January comes in hot, right, will the pundits tell you that it's all good because of price resets, and that doesn't really affect anything? Are people really going to panic over that? So I guess back to the second point is, because of that, right, we're all trying to judge what the Fed thinks. Does the Fed find that worrisome? If the Fed finds it worrisome and they have to hike more, then yeah, that's pretty bad. But if the Fed just goes like Jay Powell did last week, and they go, oh, well, disinflation is a trend, it's one blip, price reset, so forth, like, can you really get too worked up over that?
Yeah. No, it's interesting. I think the one thing that I'm kind of looking for, maybe this is a little bit of like a Schadenfreude, but I think the trade of max pain right now is what I would call like the copycat hedge funds out there. And you and I both know, in fact, all three of us know that in the finance world, there's probably a handful of really smart guys that like have the best alpha. And then there's also a room full of dudes that are just like copying everybody else, right? It's like copycat trades. They call up their guy over in, sales over at the bank, and they're like, hey, what's all the smart money doing? And then they just like yank on that trade. So imagine if you're that guy and you roll into the month of January underweight risk, right? Because you think that there's, a lot of reason to be on the sidelines, and you're probably right. Then we get this little mini rally in the first bit of the year, and, equities fucking like shoot up, crypto shoots up. And, risk generally looks good. Everyone's pricing in like the most amazing things. And then you ape in, because the worst thing in the world that you can be as a professional money manager is on the sidelines, right? Like if the market's down, you can explain bad performance, but if the market's up and you're not up, then you look like a jackass.
Yep.
So now they've followed in now, like they're aping into the market at this exact moment. I think the setup right now really is like the pain of max trade is that the CPI comes in a little bit hot and those guys just get demolished.
Yep. Right. Keep in mind, they were in 2-year bonds, right? And that actually lost value in the month of January. So that's another problem.
Yeah. So I think we might actually have a little bit of pain coming up. I jokingly said the recession was canceled, but that being said, I think reality is like we are so data dependent right now. I think there's a big risk, if there's almost an asymmetric risk just based on like flows, that if there's a little bit of like a hiccup in the CPI, there might be some max carnage going on in the market. That's just my personal view.
Yeah,
we'll see how it goes.
I mean, if you even look at, that's even outside of the flow, outside of flows, if you look at earnings forecasts, most companies are pricing in the recession. Like they're pricing that into a lot of their earnings. I'm even seeing it on the private markets as well. There's just been a total freeze in deployment within credit and private equity markets as well. Everyone's just like standing on. It's kind of like a deer in headlights situation. A lot of these companies. I mean, it's the same thing with a mortgage. You have like a giant spike in rates, and homeowners aren't going to be willing to sell their homes now at a significant loss if they think that rates might decline. Buyers aren't going to purchase yet if they think that rates might be lower. So it's just, I feel like it's kind of frozen things a little bit. You're touching on Carlos touched on something that's kind of interesting about rationality of the asset classes, and obviously last year was one of the worst years for a bond equity portfolio in history. There's so much correlation going on in the markets, and I think obviously a lot of asset allocators are looking around trying to find diversification in assets. It's kind of a trouble right now, and do you feel like a lot of that is driven because of just the Fed movements in the Fed, that everyone's just responding to these to the macro thing, and that's why that there's just there's just more correlation in the markets?
Yeah, I think the Fed is, the Fed, ECB, the BOJ, I think, a lot of that is driven by the macro environment. And I think a lot of that is also driven by COVID, right? Not all countries came out of COVID the same. Not all countries had the same COVID effect. Like as an example, like China just came out of a lockdown, in November. So I think you saw two things really happen, right? The macro environment changed because for the first time, you actually had a divergence in central bank policy. Right, the BOJ still thinks it's a good idea to ease. That's just wild. So I think that has affected the asset allocation. And I think the second thing is, demographically, the world has changed, right? And COVID really highlighted that. Think about how dependent we are on trade flows, right? Think about how dependent we are on, the labor supply of immigrants, right? COVID put a huge screaming halt to that, right? Think how Europe was dependent on cheap Russian gas. Right, the Germans had to shut down their chemical factories as they filled up the gas reservoirs for the winter. All of these things, matter for the macro trend. So I think for the first time, right, you had a breakdown. You had a breakdown in a lot of things that had worked well for, a good 12-year historical period. Right, this is the first time the Fed balance sheet has shrunk, I think, in some time. Right, think about the shrinking of monetary supply in the United States, right? And think about how that affects the cross-border flows. I'm sure you guys will appreciate Japanese investors when they invest in the U.S. market or the European markets, they hedge the FX. We're all quite cognizant that the FX rates are based on short-term interest rates. So solely because of the divergent policy of the Federal Reserve, the ECB, and the BOJ, you've had a large amount of Japanese investors back away from the U.S. dollar bond market. Right? Think about the loans, right? I think we all know there is one Japanese institution that is an outsized player in AAA CLOs. That's just crazy, right? But they had to go sell AAA CLOs because the FX hedging costs got cost prohibitive, and that almost became a destabilizing event for the Japanese financial system, right? So because of that, that feeds into the ability of less than stellar U.S. corporations to get loans. And to your point, Robert, right, that affects how private markets can access capital. So I think 2022 really is where that boiling point, the pot boiled over, the water spilled out, and people really reassessed their view of the world.
Yeah, I think that's a great point. Like one, on the Japanese retail markets, we had actually, retail and insurance, companies, basically, like we had talked about that on previous episodes before. That was going to be a major trend this year. If you're involved in the FX world at all, you know how much of a fucking monster, like what they call Mr. and Mrs. Watanabe, are in the FX markets. I mean, it's just massive. Yep. And so if those guys call all that capital home because they suddenly see a little bit of like chance of making a little bit yield in their home country, great. It's way better than punting on fucking dollar Turkey and taking a gamble on Erdogan not installing his fucking nephew as the finance minister every 3 months or some shit like that. So there's a massive impact on that. Yep. And I think that the U.S. investors are learning what the Japanese investors learned 20 years ago, which is in an environment like we have right now, where the central bank is basically becoming an outsized participant in the market. Macro rules everything. Yep. And to me, it's shocking to see. Well, I think one of the major themes of 2022 and 2023 so far that I've seen amongst my friends in the investment community across a number of different assets is like even in asset classes that historically have been known for their ability to be micro experts, meaning like if you're a VC, you previously thought your job was picking the best founding team or the best technology company. And if you were in real estate, you previously thought your job was to pick the best, cap rate, across like a number of different markets, and private equity, so on and so forth. And all the guys that thought they were whiz kids in private equity and VC and real estate back in like the late 2010s are realizing that they were just a massive beneficiary of free capital. And a lot of their models just fucking break when that pulls out. So it's kind of an interesting pullback in the markets where everyone is maybe coming to grips with how much of an impact the Fed had in their genius and their returns from 2015 to the present.
That's 100% correct, right? I think one of the lasting effects of the zero interest rate policy on investors is learning that an absolute 0% target and a relative 0% target are not the same. And I think a lot of people did not understand that, right? Thinking, the Fed is never going to raise rates, right? I mean, I think, as late as 2021, people were saying, oh, the Fed just told you that, they're going to move nice and slow. Yeah, until they decided that they can't move nice and slow, right?
Yeah, no, it's sort of crazy. I mean, we've used the quote here a bunch, but I absolutely love this Mike Tyson quote. It's like everyone's got a plan if they get punched into the mouth.
Exactly.
And I think that's been Jerome Powell. He got punched in the mouth. He's like, oh shit, what do we do now?
Yeah. That's wild. And Yang, so it's kind of like, so from your perspective, like you have this macro theme that's being so pervasive. What are some of your thoughts, even just on outside risks, like things that maybe people haven't priced in? It feels like everyone's just focused on how the Fed is going to interpret data in making their policy decisions. It seems like the world just seems very binary right now. Are there things you think that people aren't considering, or that they're outside of this that might lead to a shock, like an exogenous shock?
Yeah, I think one thing people don't discuss enough, between the Americas and Europe is really Asia. And I think two things of very notable effect can happen. The first is China, right? The Chinese reopening, I think, I've never seen anything like it. The Chinese Communist Party has prided itself as a kind of methodical rule-making organization, right? To the point where any member of the CCP can send a letter to the Politburo office and, expect their opinion to be heard. Okay, so this was like a decision-making by group. And all of a sudden you went, October, full lockdown, to November, we're going to fully reopen. And that was largely based on, the former premier passing away and the CCP leadership being afraid of street protests. Historically, street protests in China over a fallen leader's death has turned into grievances about policy. So all of a sudden, the controls of COVID went away, right? The economy opened. You probably had, 700 million people get COVID in the matter of 2 months. Just think about that. Okay, and now China's fully reopened, right? Like as an example, Chinese tourists made 166 million outbound trips in 2019. Cambodia, Thailand, Vietnam, the Philippines, right? Those places depend 20 to 30% of their economy on tourism, and primarily Chinese tourists. So you have a potential, effect here. How do people respond out of COVID, right? Are people going to want to go back and work at the factories, in Guangzhou, where they produce iPhones for, $3 an hour, right? Do people change, how their effects on that? And the demographics, like the Chinese demographic tip has gotten to the point where, because of one child and overall wealth effect, there's more deaths than births now. And that's officially been a tipping point for many societies, which goes on to the second Asia outlook, which is Japan. Kuroda term ends in April. There's going to be a new BOJ governor. And, you're at the point where the Japanese economy, 3, 5, 7%, depending on how you look at it, in terms of monetary terms, as a percentage of GDP, goes into stimulus to support the current Japanese monetary regime. So how long can you have yield curve control? You've got a bit of a reprieve, right? The Japanese, exports and the import model is very dependent on energy prices. Because of the pullback in energy prices recently, Japan's got a bit of a reprieve. As you know, there's a massive offense going on in Russia right now, right? Russia cut off 500,000 barrels of oil a day starting in the very near future, largely because sanctions has impacted how much oil, the Russian oil fields can produce. So now if you have a shock on, an import side of Japan, and you have the need to readjust Japanese policy. And Japan is, by the way, a big exporter of financial capital to the world, as we just pointed out. How does that affect, the global financial market? And that is a huge, huge wild card, because the Japanese government, I think, at the, on the fiscal and the elected side, have made some decisions that they need to adjust this policy. They're just not sure how to implement it yet.
So would you say that the effect of China reopening, but also like the lag on the economy from Japan being in like the hardest of hard places and the firmest of rocks, would those be offsetting? Or I guess what's the general effect on sort of like the dichotomy between Japan and China and where they find themselves?
Yes, I think it's I don't know if we can just rely on the former thought process, right? Because as you know, China's changed its foreign policy to much more nationalistic over the last 5 years. It's not as friendly towards trading partners, I think you've historically seen. And I think that, of course, is going to be a long run, very negative for that economy. Japan, I think, is now focused on being relevant, right? The Japanese economy, I think, while many people think it's very innovative, I think it's lost much of the innovative touch that people remember from, a decade or two ago. Think of...
Well, that's what happens when the BOJ owns all of the drivers of innovation.
Yes, and they buy equities, right? The market is... Yeah. The market has gotten there, for a couple of reasons, right? I think we can all talk about the last Japanese bubble and how that destroyed the country as a poor policy response for the last decade. But also the demographics. You just don't have enough people entering the workforce there to really sustain an innovative economy. For people like us, right? For us to have free time to innovate, to think about things, right? We have to have people that can do services for us, right? Like as an example, if there are no house cleaners on this planet, you have to go spend an hour a day to clean your house. That's an hour a day you can't do other things.
Or if there are no people to embroider Patagonia vests for you.
Right. Or no one to watch your kids, right? Or, no one to look after the elderly, right? These are real problems, on a long-term demographic trend. And unfortunately, the policy response of Japan has been to kind of kick the can down the road. So to forecast what these supply shocks will be, I think it's extremely difficult. I think the China one is easier to forecast because at some level, there's a large enough population to go and work in the factory. Maybe you raise wages a bit, you make living conditions a bit better. That, of course, happens over time as societies get wealthier, you become more productive, and that will help the West. But then you have possibly 200 million Chinese tourists looking to get out of the country and hate spend their way into happiness.
They totally are. Are you kidding me? Being cooped up over there for 3 years? I guarantee you.
Yeah. And then,
they're itching.
Yeah, and then you have a potential, very abrupt change to the Japanese monetary regime. And I think that one is a very hard one to predict because, what would happen, right? Like, do they just get rid of the yield curve right away? Do they try to do it in gradual steps? And I think one thing people don't consider is if you change the monetary regime very fast, are you destabilizing the banks? And if you destabilize the banks, how do you intermediate credit? Because what may be a very small change could end up being a disaster in terms of the cost of cleanup.
Yeah, I tend to agree with you. I think the biggest X factor in my mind is more what happens with Japan than with China. Because, as you said, China's a bit of like a known entity. We kind of know what's going to happen there. But I think that a lot of people are sleeping on the idea of how much we are dependent on basically free money flowing out of Japan and how that affects a lot of our risk capital. Because as an investor base, those guys are yield chasers,
Yep.
and they tend to be very friendly towards risk assets and risk asset classes. And if that money flows out of Western economies, I think that might be a big shock.
Yeah, I 100% agree. I think, just going back to the, AAA CLO market, right? Hundreds of billions of dollars of AAA CLOs were bought annually by a handful of Japanese institutions. That hundreds of billions of dollars supported private equity buyouts in the United States and Europe. If that even shrinks, right, that has a huge impact on private market returns, and which by effect has a huge effect on public market returns.
Yeah, no, it'll be interesting to see how everything kind of flows through in 2023. Needless to say, I do think that we've priced in maybe the rosiest of outcomes right now, and let's just pray that Chinese investors go on lots of fucking vacations and spend lots of money.
Yeah.
Although it is funny because all right, maybe taking a step back from like all the macro talk. One of the things that I think, if you look back on like B school, our generation of B school students were basically hammered in, I think, two general principles. One was that like ESG and corporate governance was going to save humanity.
Yep.
And the second was that, globalism, just-in-time inventory, and basically like, the Toyota method of just-in-time supply chains was pretty much like an immutable best practice for the entire global economy. Enough said. End of story. Those are the facts.
Yep. Yeah, and I think you bring up an interesting point about globalization, right? And I think one of the things of COVID was, the supply chain shocks that you saw, for the last 3 years. Right. At one point, you had container freight prices, hit 10x where they were pre-COVID. And right, it's brought home a lot of concepts of security in the supply chain, and it's given a lot of voices, I think, to people would have been ignored a decade ago.
Yeah, for sure. And I think, the other aspect of it is that, we've been living in this sort of Pax Americana post World War II, where aside from a couple like small proxy wars, like we've never really had wars so close to mainland Europe.
Yep.
And so all of these things that we've taken for granted, just like, free energy flow going all around the world, supply chains uninterrupted between former enemies, all in the name of sort of like, free market enterprise, and we're entering a period where I'm not going to say that's done, but certainly we're now having to call into question, what that means for us from an investment perspective. And obviously we're a crypto podcast. So for our crypto listeners, before you like say to yourself, well, what the fuck does this have to do with crypto? I can tell you, at least in my view, if you strip away the narrative about crypto, about it being, sound money and all that sort of stuff, at the end of the day, crypto really is a speculative asset, right? Because crypto is an asset class which is primarily based on a narrative around some future value. So if you think about the world of investment, you've got like these, fundamental assets which yield a cash flow. And that is just ground truth. If I buy a share of this stock, it is going to give me X% every year in terms of profitability. And then there are asset classes which are really just sort of like a hope and a dream. And I think that if you look about crypto, anyone that's really attempted to say to themselves, well, I've got this fundamental way to value crypto based on like the hash rate of the network or the number of developers or the network size using, some law. Yeah. Like at the end of the day, that's just not true. Like you look at how this thing trades, and if you look at correlations, really up until this very day, crypto trades just like levered beta on risk indices. And so you have to ask yourself, all right, like regardless of what the narrative is, right? I might say to myself, well, people finally are seeing the truth about Bitcoin, or people are finally seeing that the Ethereum merge is causing all this like fantastic stuff. And, look at all these wallets, and we're a resilient asset class, and all the bad actors are out with, no. Well, like look at like, if you look at it from like just a objective standpoint, ask yourself, how subject are we to macroeconomic moves? Well, as a risk asset, you really are a play on macroeconomics. And what people are finding with stocks, for example, I think is like, Yang and I both went to Columbia Business School, and the aspect of that was like value investing, pour over financial statements and find some cigar butts that are, valued, positive, like book to value ratio. And like that shit hasn't worked since the 1970s. Because like you find me a company that's valued based on the fundamentals. It's all just a levered beta play at this point based on macro. And so I think if you're an intelligent investor, if you get my pun,
I do get it.
If you're an intelligent investor, you're really saying to yourself, all right, well, if I'm involved in any asset class that's really just a play on the overall macroeconomic, world, especially one that doesn't have a fundamental, a fundamental value attached to it, I really need to be aware of all the drivers of macroeconomic, plays, because at the end of the day, Bitcoin is probably at its purest form, just levered beta that's very driven by macroeconomic moves. And I will fight anyone that tells me that until the data tells me otherwise.
Yeah, I mean, it's kind of wild that people even think that you can value crypto on a fundamental basis. Like equity managers can barely forecast the equity returns of their publicly traded companies beyond 3 years. Like 5 years is a long time to be valuing cash flows for a lot of equity managers. And when we're talking about crypto, it's still such an nascent stage. Like you need to be thinking like 10 years, like 15 years, like what will that world look like? Like it's just like sometimes I think people get it's not easy to do even in other asset classes which have been around a lot longer than this one,
Yeah, I think when I look at macro, typical asset classes that are dominated by macro. So for example, if you look at FX is probably one of the biggest macro plays. And as Yang was saying earlier, FX is primarily valued based off interest rate differential, right? So like if it's cheaper to borrow in one country than the other, then it has an impact on the price, and kind of standard derivatives pricing models. But that's actually not fully true, because especially since Dodd-Frank, where the market is now constrained by liquidity.
Yep.
Meaning when there's just a shitload of liquidity going through the market's really efficient. But whenever you have any liquidity constraints, what usually ends up happening is like central banks will set their rates every 6 weeks or so, and that will reset FX because there's an actual fundamental driver in the way that things are priced, and then the rest of it's just kind of punting.
Yes.
And historically, the way that would work would be that macro funds would tell clients what their view on macro was. But at the end of the day, the way they made their money is they would call up the trader at JP Morgan and they would say, "Hey, dude, which way are corporates positioned on their FX hedges rolling into month end?" And they'd be like, "Oh, corporates are buying euro," and so the hedge funds would just kind of like get in front of that flow coming into month end. And so the majority of money that was made in macro, regardless of the story of everyone being like, "Oh, well, I have this view on rates and I have this view on what Jerome Powell or whomever else is going to do going forward in the future," is really just based off of supply and demand, and having a better view on what flows were going through the FX and the rates markets. And if you could do that, if you could be big enough and you could see enough of the market, and you had a phone call into the biggest broker dealers, then awesome.
Yep.
Well, suddenly post Dodd-Frank, that's illegal now.
Yes.
Right? Like you can no longer give color on explicit client flows. So those guys start flying blind. And funnily enough, all of those macro funds that were flying high back in the day are suddenly having massive investor outflows because they can't keep up with their returns because their source of alpha is now gone. Yep. And so macro has been historically a really, really, really fucking difficult asset class to price, because there's no inherent value. You're just sort of making punts on what you speculate a central bank may or may not do.
Yeah, and I think if you bring up a very interesting point, right? Because if you go back, I think, to the 90s, if you guys remember, there was a whole discussion of the bond massacre of 1994. And in 1994, the Fed raised or lowered interest rates at the whim. So how you found out about it is when you logged into your tell rate system and you noticed that the Fed funds level from the Federal Reserve Bank of New York has changed overnight. And that is how you found out the Fed has raised or lowered interest rates. So if you were, again, to your point about, information advantage, right? Like the value investing thing worked well in the 70s because you know what? There was no internet. So you can just pay someone to go stand outside the SEC. When the SEC filing came in, you were the first person to get it. You read it, and you had someone at the payphone to call you in New York to tell you what the actual numbers were. You wrote that down, and you go, wow, this company's great, or wow, this company sucks. And you bought and sold that company shares before anyone else. Information is a great equalizer, right, in that front.
Yeah. Well, it's a funny story because one of my favorite stories about markets going way, way, way back was that Nathaniel Rothschild actually found out that the British had won the Battle of Trafalgar because he had invested in carrier pigeons. He had a network of carrier pigeons that were faster than anyone else's. And so he found out about it and spread rumors that the French had won. And then when everyone sold off, he bought it. And then 2 days later, when the information rolled in that the English had actually won, he had cornered the market. And so you actually see various implementations of that across markets today. And now we actually fight the exact same battle in markets, but rather than carrier pigeons or hiring a dude to stand outside the SEC and be the first one to file it, that's now like microwave connectivity between New York and Chicago. And so I think one of the interesting things about like macroeconomics is that even though everyone kind of has a pontificated view of macro, at the end of the day, the best way that people express all of these macro views, and you'll see this with like a lot of the hedge funds that used to be known for being macro funds, they've all pivoted to being quant funds now. So like Citadel, Millennium, AQR, like all these funds that used to like have their bread and butter be like, oh, we sit around and we pontificate on, on rates and Fed fund moves and that sort of stuff. They've all now moved to high frequency, algorithmic trading firms because really at the end of the day, that's really the only way to get an edge at this point.
Let's say, like over time, the market structure will of course evolve. And, to be a nimble, thoughtful investor, right, you have to evolve with the market.
Yeah. So on that front, I think we've seen a lot of evolution of markets over the past couple of years. There's been a bit of a migration away, and Rob's actually talked about this before, away from like active management more to like passive management. Let's talk a little bit about sort of how the asset flows have changed and where they're getting allocated across like the different ends of the spectrum from, purely passive to active funds and everything in between. Like, what do you see in terms of, what the investor sentiment is towards investing in a number of these types of different products?
Yeah, no, I think I think we have to split the world into really three pieces now, right? And it's really done on asset class. So you have equities, you have fixed income, and then you have multi-asset and other. So if you start with equities, I think, ETFs, right, are 75%, 80% equities. And I think the last 2 decades, you've seen outflows from active mutual funds into passive ETFs. And that trend has no way of slowing down. I think it's been relatively well demonstrated that the S&P 500 or any number of, large cap indices, that are market cap weighted will outperform, an active manager over a 3 to 5 year period. And the ones that do outperform, in a 1 to 2 year period, they have a hard time sustaining a multi-year outperformance. So unfortunately, there is no way to break that trend. And again, it goes back to the information advantage that active investors had over time, and that's been whittled down to zero. And fixed income, you have not quite seen that trend yet. You haven't seen that trend yet because the indices are not there. The biggest, bond index in the world, is the Barclays Ag, the Bloomberg Ag now. The Ag is like 30,000 bonds, and it's market cap weighted. The biggest benefit of the Ag, in my opinion, is it goes, it's licensed by active bond managers, and they talk about how they beat the Ag. little known fact, 85% of active fixed income managers beat the ag. How do you beat the ag? It's actually really simple. The ag is market cap weighted by issuer. So the biggest bonds in the ag are government bonds and agency-backed mortgage bonds. So you want to beat the government bond and the agency bond market? Yeah, just buy a little bit of IG credit and magically you beat the market. The 16% or the 17% did not beat the ag. Very curious to know what your thought process was. Very curious. So when you think about that, right, the idea is, and this is what Arch is built on is, we want passive strategies, rules-based, methodical. And, the idea is to win a little bit over time rather than to win a lot today or tomorrow. So, our idea is to have stability, low turnover, and we optimize for a target. So going to the third class, the multi-asset, this is kind of, esoteric asset classes, maybe real estate funds, commodity funds, maybe some multi-asset funds that still exist. This is kind of where those people sit. And that's not well defined because it's pretty much the other bucket. And the other bucket, of course, is very esoteric, right? There's no way to really kind of have a blanket statement about them other than they don't fit one of the two boxes. But it's only a matter of time before I think people come up with methodologies and indices to track markets in an efficient manner. And when you have that, you can use that as the building block to build a second order product, which is products that help investors asset allocate or help investors meet goals in a thoughtful manner. And our goal is to have low cost, efficient products. While we're not going to have bells and whistles, we're never going to be an alpha generator. We have a way of giving you a goal-oriented exposure at a reasonable price.
Interesting. Some of your comments here, just like in thinking about how all of this kind of relates also to cryptocurrencies. Like you mentioned something like I just about that information advantage and how it's kind of democratizing information, having it equally accessible to all is a benefit to everyone, and kind of can remove some of those other players that had asymmetric information advantages. I look at like areas within the crypto markets like DeFi, which have been, I think, like there have been some phenomenal innovations in that space. You have things like Uniswap, that decentralized exchange. There's a whole host of other projects out there that have been amazing work there in providing access to finance. But the tokens, the actual profitability of their underlying protocols hasn't really accrued to those who are owning the governance protocols as much as it has been. The value has really accrued to the market participants. I just think of I can't help but seeing some correlations there between what you're mentioning and what we're seeing happen in the crypto DeFi space.
Yeah, I think it's somewhat sad to me though, because I see this all the time. As a case in point, like there's, I'm not going to name it, but there's a protocol to provide like what's called an Oracle network of pricing out to the market. And it's got all these like high frequency trading firms that give pricing to it. And when that happened, everyone was like, oh my God, this is such an altruistic thing that's happening by these providers. They're giving this like fantastic service. I'm like, bullshit. No, I know those guys. Those guys don't do fucking anything unless they know they can manipulate the market and make money off of it. And it's like if you have a DeFi protocol that's supposed to be like, this Oracle network that gives free and democratized pricing to everybody, but the people that generate the pricing are high frequency traders. It's the exact same thing that happened in banks a number of years ago, where it's like, by the way, we have this magic thing called LIBOR. And the way that we determine the LIBOR pricing that the banks set all of their derivatives contracts to is the banks just tell us what the price should be. And we trust them. Right. Yep. and so I think that there's a lot of what I would call like democracy projects. They're not really democracy projects. And so I think every time I look at these sorts of things, I always think about like, all right, well, where's the Trojan horse at here? And so I think it's incumbent upon investors to really have a good understanding about what truly is an index or passive, and what is a bit of gamesmanship, and who's providing information to this index, and how can that index be gamed in such a way that screws me.
Yeah.
And that's hard. It's really hard to do.
Yeah, and I think, this problem will never go away, right? I think, when you think about data, right? Data is kind of like land. It's kind of valuable, but not really valuable, right? Like think about like exchange, like the New York Stock.
You don't use it for something; it's not very valuable.
Like think about this. Like if all you did was scrape, trace data and then you sold that, right? Like that's valuable if it's a usable format. But there has to be a data repository. Like for example, equities is very simple. It's actually very simple to build equity-based index products because there's only one place you can transact equity securities, and that's through the exchange. So the data from the exchange is public. Everybody has it. Everybody knows, like, if you trade, 1 million shares of Google, that has to be printed at the exchange. The fixed income market, for one of the reasons why indices is not really taken off there is it's a dealer market. While you have to report, fixed income trades to trace and so forth, it's actually very difficult to transact without, one, a centralized place, and two, a lag on volume data. So, when you go outside of those, those two kind of asset classes, right, it becomes a little bit trickier to get, to your point, verifiable data, knowing that that's correct and knowing that, the actors behind it are doing this with real intention to trade and not a malicious intent.
Yeah. AKA anything Citadel does.
You said it, not me.
Let's just put it this way. Citadel will probably never want to acquire DeepQ Digital. But maybe I'm being too harsh, but effectively, like the way I look at it is, for every benefit of truly democratized and exchange traded market, there exists somebody who can start to use rent-seeking behavior to effectively be a tax on the market. And that's how you get, firms. And I use Citadel as an example because they fucking printed like, $40 billion P&L last year. And the primary component of their business is basically, arbing the regulatory requirement to, print inside the national best bid and offer, while being able to, do a ton of business inside of that on dark pools and a number of different other locations. So I think like I'm always, and maybe because I come from FX, which is sort of like, if you think of like the spectrum of the world where equities and are all index driven and exchange traded, and then the US rates market is somewhere in the middle where you've got trace that you have to like, put it to 24 hours later after the fact. But it's still very much a dealer market to FX, where it's like a purely dealer market. Everything's bilaterally traded. Maybe I'm a little bit biased in terms of my view. I'm going to own that one.
Yeah. And I think, I think the reality is, right, market participants themselves have to have some level of comfort in how they transact. For us, we're all professionals, right? Like, I am setting up as a registered investment advisor right now with the SEC. So by definition, I am a qualified institutional person. So, in that regard, I represent to people that I am a professional and I'm a big boy. But if you show up on your Robinhood app and you start buying and selling crazy things, while that is, of course, you are allowed to do, there should be no rule stopping anyone from access to the market. You have to be mindful of how you participate and how you transact. Are you doing that in the best manner that you could do it in? And that's where I think it's important, right? To have, a good marketplace as well as, a code of conduct for the agents involved.
Yeah, because nobody wants to be on a Gary Gensler TikTok video.
Yes, that would be bad.
Unless it's you interviewing him, and then that would be pretty interesting.
I remember when we first left business school, all of us probably had a similar speech, which is something along the lines of like, never put anything in email or never put anything in chat that you wouldn't want to have on the front page of the Wall Street Journal. And I would imagine that all the grads leaving school today are probably showing up, and there's some senior manager at JP Morgan or Morgan Stanley or whatever that's like, listen, guys, never put anything that you don't want to show up on a Gary Gensler TikTok video.
Yes, it's probably not a good idea to do a day in the life of the trading floor all day, every day.
Yeah.
I'm so curious how many young Gen Z and millennials follow Gary Gensler on TikTok. He's hip.
Well, he's going for a following. He's certainly putting out a lot of videos these days.
Oh,
So,
the legacy. Boys,
it's fantastic.
I think we went over an hour, guys. This is a great
Yeah,
chat.
we covered a lot of ground.
Yang, you are a treasure trove of information. I really enjoyed having. It was really great chatting with you. It was really good. I'm glad Carlos reached out.
Yeah, for
Thank
sure.
you so much.
Yang, why don't you tell everyone where they can find you?
Yeah, so we're on LinkedIn right now. We're putting our kind of internet presence up. We're not quite fully public yet. We are in the process of onboarding a marketing person to be our outsourced CMO. So we're all going to be on the internet soon enough. But right now, it's Arch Indices. You can find me on LinkedIn. You can find me on Insta. You can find me on TikTok. We would love to connect. And if you guys have interest in our product, we can, of course, have a conversation about it. But it was a pleasure to be on.
Yeah.
Really appreciate the chance to connect with you, Rob, and Carlos. It's always fun to get beers and catch up on life, and
and wear vests.
Wear a vest.
Yeah. One quick shameless plug for Yang's Instagram channel. Whether or not you end up being a customer of Arch Finance or at all, but I can honestly tell you that his Instagram account, Chats with Yang, is my go-to for really quick and digestible macro updates every single day. So he puts out very, very, very succinct updates on the market. It's been a useful tool for me. Like, I hate to say that I get macro news from Instagram, but if you trust the source, it's actually a very nice digestible way to do it. So I highly recommend you give him a follow and find him where you can on LinkedIn and Instagram.
Thank you so much, Carlos. Really appreciate it.
Yeah. All right, boys. Have a great weekend. Always a pleasure. And thanks for joining the Deep Q Cast.
All right, thank you. Take care.
Take care.